You get the offer. You open the email or the PDF or the term sheet, and for a second your brain just goes blank. Then the number hits you. And your first reaction is not gratitude. It is, what the hell are they looking at? Because from your side, the business is real. Real customers, real margins, real employees, real years of your life. You've been carrying this thing on your back for a decade or more. And now some buyer sits there and acts like they're doing you a favor with a number that feels insultingly low. So you do what most owners do. You tell yourself they don't get it. You tell your partner they're lowballing you. You tell your advisor the market is wrong. And maybe sometimes that's true. But most of the time, it is not. Most of the time, the buyer understood the business better than you realized. That's why the number hurt, because they were not pricing your business the way you think about it. They were pricing the part of your business they believe could fall apart once you step out of the room. That is the part most owners never see coming. They are not pricing your EBITDA, they are pricing your absence. And that changes everything, because the minute a buyer starts asking, what happens when this owner leaves? The game is no longer about what the business earned last year. It is about what it will still earn after you are gone. And if you have spent years becoming the glue, the closer, the problem solver, the person every major customer trusts, then you may have built something far more fragile than it looks. That is the brutal truth. I spent a long career in M&A thinking I understood how exits were supposed to work. You put together the presentation, you send it out, buyers come back, you negotiate, you close. That was the script. That was the machine. And for a long time, I just followed it. Then I watched my friend Adam go through the process, and I felt helpless because Adam thought he was stepping into the finish line. He thought the sale would be the payoff, the reward, the moment years of grinding finally turned into freedom. Instead, it turned into a slow beatdown. He got shortchanged on the upfront cash. He got tied up in a 3-year earnout. And then the buyer loaded the business with capital expenditures and management fees, which meant he ended up losing on the earnout anyway. So what looked like a sale on paper felt like getting stripped down in real life. No clean exit, no clean win, just a deal that kept moving the goalposts after he had already signed. He was drained. He was mentally exhausted. And he felt completely shortchanged. What made it worse for me was that I was buried in my own business at the same time, trying to close deals, trying to keep everything moving, trying to stay ahead of the chaos. So I knew what was happening to him. I knew he was getting worn down. I knew the process was taking more from him than it should. But I was too consumed by my own work to step in the way I wanted to. That stayed with me, because I know what it takes to build and run a business. The pressure, the long days, the constant problem solving. The weight of making payroll, keeping customers happy, managing vendors, handling people, and carrying your own family's future at the same time. Most owners never get enough credit for how brutal that actually is. They make it look smooth from the outside, while quietly holding the whole thing together by force of will. So when you finally get to sell, you expect that to matter. You expect the market to respect what you built. You expect the buyer to reward the risk you took. And when they do not, it feels personal. It feels like disrespect. It feels like somebody looked at your life's work and decided to reduce it to a line item. That is why these deals can hit so hard. Not just financially, ego-wise, emotionally, identity-wise. Because for a lot of owners, the business is not just an asset. It is proof that the years meant something. It is proof that the sacrifice was not wasted. It is supposed to turn into a nest egg, a cushion, a real outcome. And if the exit goes sideways, it can feel like the final insult after years of being the one who kept everything together. Here's the thing most sellers never get told. The problem is usually not just the business, and it is not just the buyer. It is the gap between how you see value and how they see risk. You see the business from the inside, they see it from the outside. You see the hustle, they see dependency. You see relationships, they see concentration. You see intuition, they see missing documentation. You see what the business could become, they see what could go wrong after you leave. And somewhere in that gap, value starts disappearing, not all at once. Quietly, a little here, a little there, until the offer on the table feels like it came out of nowhere, when in reality it was being built piece by piece from the moment they started asking questions. That is what makes this dangerous, because if you've spent 10, 20, or 30 years building a company, you are not just selling a business. You're trying to turn all of that into a future for yourself and your family. You are trying to create freedom. You are trying to make sure that pain meant something. You are trying to walk away with dignity. And if the structure is wrong, the number that looks good at first can turn out to be the wrong outcome entirely. If you want to know where your business really stands before you ever talk to a buyer, I've put two links in the description on the getdealflow.ai website. One is for your exit readiness score. The other is for an estimated business valuation. Use both before you go to market, because the right starting point changes everything. Now let's talk about what is actually going on behind the scenes when a buyer looks at your company. Most owners think the buyer is doing a simple math problem. Take EBITDA, apply a multiple, done. And yes, that is part of it. But there is another layer running underneath that. And that layer is where a lot of offers get cut down. The buyer is asking a much darker question. What will it cost to replace the owner? Not in theory, in reality. Not just payroll, not just salary. Everything, the relationships, the judgment, the vendor leverage, the pricing instincts, the speed of decision making, the stuff you do every day without writing it down because it lives in your head. That invisible layer is what makes some businesses feel easy to buy and others feel impossible to trust. If the entire company is built around you, the buyer sees a transition problem. And transition problems are expensive. They mean more risk, more delay, more uncertainty, more ways for the deal to go bad after closing. That is why the multiple changes, not because the business is bad, because the buyer is asking how long the earnings will survive without you standing in the middle of everything. That is a very different question, and it matters a lot. If the buyer thinks the business will keep humming when you are gone, the multiple goes up. If the buyer thinks the business might wobble the second you step back, the multiple gets crushed. That is not emotion. That is underwriting. It is a confidence score disguised as a valuation. And once you see it that way, you start to understand why some offers feel offensive. They are not judging your effort. They are discounting the transition. Then there are the silent killers, the stuff owners often do not want to admit is a problem because from their side it feels like strength. The first one is customer concentration. You have a big customer. Maybe your biggest one is a third of revenue. Maybe that account has been with you forever. Maybe they love you. Maybe you know the CEO's family. Maybe every renewal has gone smoothly. From your point of view, that is a beautiful relationship. From the buyer's point of view, that is one phone call away from a disaster. Because if one customer matters too much, the whole business can wobble if that account leaves. And buyers are not in the business of paying top dollar for things that can break on one bad quarter. That does not mean the relationship is worthless. It means the relationship is a risk if it is too concentrated in one place. The second killer is the black box problem. This is the one that really catches people off guard. You know exactly why your margins are better than the competition's. You know which vendor to call. You know when to push. You know when to hold. You know how to get the real price instead of the list price. You know what not to say on a bad day so a deal does not die. The problem is, if all of that lives in your head and nowhere else, the buyer cannot underwrite it. They can see the margin in the historical financials. They just cannot prove it will survive when you are gone. So they discount the business. Not because the margin is fake, because the margin is fragile. The third killer is growth that looks good but burns cash. This one is sneaky. Everybody loves a business that is growing fast. But if growth requires more working capital every month, more cash tied up in receivables, more inventory, more pressure on the balance sheet, then the buyer is not just buying growth. They are buying a cash drain attached to the growth. And if the returns do not justify that strain, the offer comes down. Again, not because the business is bad, because the economics are harder than they look. So now you have three big things working against you: concentration, founder dependence, fragile growth, and that is before the buyer even gets to diligence. At that point, the offer is not just a number. It is a map of the risks they think they found. And if you do not know how to read that map, you will waste time arguing about the wrong number. That is the point where most owners make a huge mistake. They negotiate on price when they should be negotiating on risk. A seller who argues this is too low is arguing about the conclusion. A seller who asks, "What exactly are you worried about?" is getting to the cause. That is where the leverage is, because once you know what they are worried about, you can start fixing the actual problem. Take the letter of intent. Most owners read the LOI like it is the finish line. It is not. It is a risk map. Every clause below the headline price tells you what the buyer does not trust yet. If they ask for an earnout, they are telling you they do not fully believe the earnings will survive the transition. If they want a big escrow, they are telling you they are nervous about something that could blow up after closing. If they start pushing hard on working capital, they are telling you they think the business may need more cash than your model suggests. If they keep revisiting quality of earnings adjustments, they are telling you something in the financial story does not feel stable. None of that is random. It is all signal. And if you learn to read it properly, you stop treating the offer like an insult and start treating it like intelligence. That does not make the number feel better, but it does make the next move smarter. Because now you know what the buyer thinks is broken. And that matters more than whether they are being polite. This is why I stopped thinking like a banker who just packages the deal. I started thinking like someone who had to fix the deal before it hit the market. That shift changed everything, because the best exits are not created in the last round of negotiation. They are created months or years earlier by making the business easier to trust. That means building a company that can survive without you standing in the middle of it. That means creating real management depth. That means documenting how the business works. That means making sure the customer relationships are not all trapped in one person's phone. That means making the financials clean enough that the buyer does not have to guess. That means making sure the business looks less like a founder's hustle and more like an asset somebody else can own without panic. That is hard. It takes time, it takes humility, and it often means admitting that what felt like strength on the inside can look like fragility from the outside. That is uncomfortable, but it is also where the money is. I saw this in one deal that still sticks with me. The business had already been offered $90 million. On paper, that sounds like a serious number, a real outcome, something to celebrate. But when we dug in, we found 5 weaknesses that were holding the value back. The owner was too central. Margins moved around more than they should have. The financial story was too messy. Customer concentration was too high, and the wrong buyer had been looking at it. The business itself was not broken. The way it was being presented was, so we did not rush back to market. We stopped, we cleaned it up, we repositioned the company for 12 months, we stabilized margins, we reduced complexity, we built a stronger management layer, we made the owner less central, we cleaned up the books, we made the business easier to underwrite. Then we went after the right buyers, not a random blast, not a mass email circus, the right buyers, the ones who could actually justify premium value. And once the business was truly ready, the difference was obvious. The conversations changed, the objections dropped, the diligence got cleaner, the urgency went up. The deal moved faster, and the business ultimately closed at $240 million with 0 retrades. That is not luck. That is design. That is what happens when the company is built to survive the transition instead of hoping the buyer will overlook the risks. And this is where Adam comes back into the story, because I could not shake what happened to him. Not just the money, the emotional hit, the feeling that he had worked so hard for so long only to come out of the process tired, disappointed, and shortchanged. That part mattered a lot, because no founder should spend years building something meaningful and then feel like the system took more than it gave back. That is the gut punch. That is why this matters. Not because a buyer was rude, not because the market was unfair, but because a seller can spend a decade building something real and still get punished for the exact things that made the business work in the first place. So what do? You stop trying to impress buyers with the old story. You start building the version of the business that a buyer can trust. You make it easier to run without you. You make it easier to understand. You make it easier to believe in. That is the real work. And it starts long before the sale process begins. If you're even thinking about selling, I have put 2 links in the description on the getdealflow.ai website. One is for your exit readiness score. The other is for an estimated business valuation. Use them before you go to market and before a buyer tells you what your business is worth. Because if you do this right, the exit should do what it was supposed to do in the first place. It should reward the years you spend building. It should create the nest egg. It should protect the upside. And it should feel like the finish line, not a fight you have to survive. That is the system I believe in, and that is the system we are building.